Welcome to This Explainer. Okay, today we're diving straight into the surprisingly high-stakes world of inventory valuation. I know, it might sound like, standard everyday bookkeeping, but as we're going to see from our source material, a single, tiny math error on a box sitting on some dusty warehouse shelf, well, it can actually cascade and completely shatter a company's entire financial record.
So, here's our roadmap for today. We're going to cover the basics of inventory, cost versus net realizable value, creating valuation statements, the domino effect of errors, and finally, the impact on next year. Let's get into it.
Section 1. The basics of inventory. What exactly is on the shelf? We're starting incredibly small here just to establish precisely what we mean when we use the word inventory in an accounting context. Picture this, physical goods, like maybe some tablets at an electronics store, just sitting there unsold at the very end of a financial year. This is the micro-level starting point of our financial journey. Before we crunch any numbers at all, we really have to recognize that we're dealing with actual tangible items.
So, the crucial point here is that inventory is formally defined as a complete list of goods on hand at the end of an accounting period. And that includes raw materials, work in progress, and finished goods for a manufacturer, or, just the everyday products bought for resale by your local retailer. It's not just some abstract number on a ledger. These physical assets often make up the absolute largest current asset a business holds. They form a massive part of the cost of sales and directly shape the statement of financial position.
Moving right along, Section 2. Cost versus net realizable value, otherwise known as the golden rule of accounting.
Now that we know what inventory actually is, we have to figure out exactly how much it's worth. And we do this by comparing two distinct valuation methods. First up, we've got cost. And listen, this isn't just the sticker price. It includes literally everything needed to get the item into your warehouse and ready to sell. Stuff like carriage inwards, import duties, packaging, you name it. Then on the flip side, we have net realizable value, or NRV for short. Basically, this is what you actually think you can sell the item for after deducting any extra costs required to complete the goods and make that eventual sale.
If you're ever confused about calculating NRV, just follow this super simple two-step formula. Let's say you have an item that originally cost you $400, but it got damaged. If it's going to take $100 to fix it and you can only sell it for $300, well, 300 minus 100 means your NRV is now $200. It's that easy. You just use this to figure out the actual real-world value of an item that might be damaged or obsolete.
And honestly, this brilliantly illustrates the guiding philosophical theme for this entire explainer, the prudence principle. As our source highlights, the prudence principle requires assets to be undervalued rather than overvalued. It explicitly tells us to never, ever be overly optimistic about the value of our assets. Period.
Because of that exact principle, we arrive at the absolute golden rule of inventory. Always value inventory at cost or net realizable value, whichever is lower. So if a major price fall happens, or maybe an item just goes totally out of fashion and its NRV suddenly drops below its original cost, you've got to take the hit. You have to value it at that lower NRV.
Which brings us to Section 3, creating valuation statements, item by item.
Let's see how this actually plays out in a real business application. We're going to look at a scenario from a business owner named Sita. Notice how she applies that whichever is lower rule line by line. It's pretty cool. For item 1, the cost is $500, which is lower than the NRV of $560. So its final value is $500. Simple, right? But for items 2 and 3, their NRV is actually lower than their cost. So Sita, being prudent, correctly values them at $230 and $170 respectively. Adding those carefully chosen lower values up gives her a total inventory value of $900.
But wait, this brings us to a massive pitfall, and I cannot stress this enough. You absolutely cannot just sum up the total cost of all your items, sum up the total NRV of everything in the warehouse, and then just pick the lower total. No way! It is completely incorrect. The prudence rule must be applied individually, item by single item.
So what happens if we mess this up? Like, what happens if we completely ignore the rules and accidentally overvalue our closing inventory? Well, this brings us to a terrifying narrative hinge for any business owner. What are the actual stakes if we get this valuation wrong?
Section 4, the domino effect of errors, when tiny mistakes cascade.
We're now zooming way out from that single item on a shelf to watch how one tiny overvaluation triggers a catastrophic domino effect across an entire company's financial statements. Take a trader named Akio, for example. If his correct gross profit is $400, but his overstated gross profit sits at $500,
Well, why did it jump? It's because closing inventory is subtracted when calculating the cost of sales in a trading account. So if you artificially inflate that closing inventory number, your cost of sales drops. And guess what? That artificially inflates your gross profit right alongside it.
To truly grasp the sheer scale of this danger, let's look at a scenario from our source involving Dell Computers. They made a calculation error and accidentally overvalued their closing inventory by $25,000. Just one single valuation mistake. At the end of the year, whoops. Now, listen to the casualties of Della's error because it's wild. That $25,000 mistake didn't just quietly sit there in the trading account. Oh no, it acted like a virus. It overvalued the gross profit. And since profit for the year is gross profit minus expenses, the profit for the year was overvalued too. Because inventory is an asset, current assets were overvalued, which means total assets were overvalued. And since profit is added to opening capital, the owner's equity was entirely overstated. Literally everything from top to bottom was artificially pumped up.
Section 5, Impact on Next Year, the Ghost of Inventory Past. But here's the kicker. The nightmare doesn't just stop on New Year's Eve when the books close. No, let's see how this accounting error actually time travels to infect the future. Let's walk through the timeline. Point 1, year 1 ends with an overvalued closing inventory. Okay, now, point 2. Because year 1's closing inventory automatically becomes year 2's opening inventory, the ghost of last year's mistake instantly haunts the new financial calendar. The opening inventory for the new year is just dead wrong right out of the gate. And this leads us perfectly to point 3. Ironically, starting the year with an inflated inventory means your opening cost of sales calculation is now way too high. So when you subtract it out, it artificially depresses your gross profit and your profit for the second year. Sure, the owner's overall equity eventually balances out across the 2 years, but your year 2 performance looks artificially terrible, all because of a mistake made 365 days ago. Crazy, right?
Which brings us to a final question to leave you with today. Is your business's entire financial health currently resting on a single, overvalued item sitting quietly on a shelf somewhere? When we realize how a single calculation error cascades from cost of sales to total assets to owner's equity and even into the very next year's profits, well, applying the prudence principle becomes a whole lot more than just some textbook rule. It's absolute business survival. So take a close look at those shelves, apply the lower of cost or net realizable value item by item, and ensure your financial foundations are built on solid reality, not optimism. Thanks for joining me on this explainer, and keep learning.